Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$6 even. That is the number just glaring at us from the ticker tape today. We are hovering right at a psychological precipice. I mean, if you look at the last few weeks, Nuvation Bio has surrendered nearly 30% of its market cap. It has just been a relentless slide. We're looking at a relative strength index, the RSI, sitting at 27.19. And for anyone who doesn't, stare at charts all day, anything under 30 is technically oversold. But while 27 is deep in the basement, it suggests panic, not rational pricing. The stock is broken down below the 50-day moving average at 695 and the 200-day at 831. The technical damage is it's undeniable.
It's a bloodbath. There is really no other way to frame it. You have a stock that is acting like a falling knife, and in this market, well, trying to catch a falling knife usually results in losing a few fingers. But the central question we have to answer today isn't just about the red on the screen. We need to figure out if this is what we're calling the great divergence. Is this a massive dislocation between a company that is fundamentally executing on its drug launch? Or is the market actually being efficient here? Is it correctly pricing a distressed asset in a trade that just got way too crowded?
It is absolutely a divergence. In fact, I'd argue it's the most significant disconnect between price and intrinsic value in the entire biotech sector right now. I'm looking at this and seeing a classic commercial transition dislocation. We see this all the time. Companies moving from the sexy speculative R&D phase into the gritty quarterly earnings reality of being a commercial company. The shareholder base churns and the stock gets punished. But the market is pricing Nuvation as if the IBOI-Trozi launch is failing or as if the balance sheet is crumbling. And when you look at the actual empirical data, the reality is the exact opposite. We're looking at a fortress balance sheet and launch metrics that are defying gravity.
And I'm looking at this same screen and seeing a trap. The technicals are screaming exit. You have short interest creeping up. You have a massive sell the news reaction to the ICI deal, which we definitely need to unpack. And perhaps most damning, you have a revenue miss against the whisper numbers. In a high-rate environment where capital costs money, price action is truth. And right now, the truth is ugly.
I think the truth you're seeing is a mirage, one caused by short-term liquidity mechanics, not business fundamentals. So let's start with the safety net. My stance is simple. Nuvation Bio is effectively funded to profitability. They have a pro forma cash position of approximately $615 million. That accounts for the Q4 milestone and the ICI upfront payment. They don't need to raise money. In small-cap biotech, the constant threat of dilution is what usually crushes stocks. That threat? It just doesn't exist here.
Cash is king, sure, but cash burn is the emperor. If the launch fails, that $615 million just evaporates a little slower. A fortress balance sheet is great, but it's not a business model.
But the launch isn't failing. This is the core metric the market is completely ignoring, the 6x signal. The commercial launch of Trozi is outperforming historical benchmarks, specifically repogitectinib, the Bristol-Myers Squibb asset, by a factor of 6. They put up 216 new patient starts in Q4 alone. That is not a failure. That is a vertical launch trajectory. The fundamental reality is strong. The price is wrong.
I admire the optimism, but let me pour some cold water on that. My position is that the market is a discounting mechanism, and right now it is discounting a future that isn't as rosy as the slide deck suggests. Look at the psychology here. The stock is down because of thesis creep. The bulls were praying for a buyout, an M&A exit. They wanted Pfizer or Merck to write a check for $20 a share. Instead, they got a licensing deal with ICI. The stock dropped 20% because the buyout premium vanished, instantly. Furthermore, you mentioned revenue. Actual Q4 revenue was $15.7 million. The street whispers, the numbers the hedge funds were actually betting on, were closer to $16.4 million.
A $700,000 miss? That's a rounding error in a launch ramp.
In a spreadsheet, yes, but in market psychology, it's a disaster. It tells investors that management's guidance might be too aggressive or that the uptake is hitting a wall. In a growth transition, you do not get to miss expectations even slightly. The massive drop we are seeing isn't just retail panic, it's structural selling from funds that have strict rules about holding companies that miss their targets.
Okay, let's dig into that wall. You're focused on the snapshot of Q4 revenue. I'm focused on the slope of the line. The debate really centers on whether this launch is durable or if it's a flash in the pan.
Precisely, and I challenge that durability. The ROS1 market, the specific type of lung cancer we're talking about, is not an open field. It is a knife fight in the phone booth. It's a tiny patient population. You have Pfizer with Xalkori, you have Roche with Rozlytrek. These are behemoths. They have bundling power. They can go to a hospital system and say, if you buy our lung cancer drug, we give you a discount on our breast cancer drug. Nuvation is a standalone biotech. They don't have that leverage. My concern is that the numbers you're citing, those 216 new starts, represent the bolus.
The pent-up demand.
Exactly. The backlog of patients who are waiting for a new option. They all jumped on board in Q4. Once you work through that initial bolus, the adoption curve flattens out. Can Nuvation really compete against Pfizer's sales force long-term? History is littered with small biotechs that had a better drug but got crushed by big pharma commercial infrastructure because they couldn't get in the door.
That is a fair concern in the abstract. If this were a commodity product, Pfizer would win every time. But in oncology, specifically in this indication, clinical differentiation matters more than bundling. Ibtrozi isn't a me-too drug. It solves the two fundamental failures of Xalkori and the earlier generation TKIs, resistance, and most critically, the blood-brain barrier.
The BBB argument.
It is the single most important factor. We know that ROS1 positive non-small cell lung cancer has a notoriously high propensity for CNS metastasis, spreading to the brain. Xalkori is a large molecule. It effectively bounces off the brain's protective lining. It doesn't get in to kill the cancer there. Ibtrozi does. We're talking about a median duration of response, DOR, of 50 months. That is over 4 years of disease control. If you are a doctor, you can't ethically prescribe an inferior drug just because the sales rep brought you lunch.
Duration is great for the patient, obviously, but strictly from an investment standpoint, uptake is the metric that drives the stock price today.
But the uptake is driven by the side effect profile. This is the cleaner CNS profile argument. Let's talk about the competitor, repotrectinib. It has significant liabilities regarding dizziness and TRK inhibition. TRK inhibition affects proprioception, your body's ability to know where it is in space. Patients get dizzy, they fall. If you're an oncologist and you have a patient who wants to maintain their quality of life, walk their dog, drive their car, are you going to prescribe the drug that makes them feel like they just stepped off a spinning teacup ride or the one that has a clean profile? That is why we are seeing that 6x adoption rate. It's not just efficacy, it's livability.
I get the quality of life argument, but let's look at the math again. You dismissed the revenue miss earlier, but if you look at the bolus theory, if you annualize that $15.7 million in Q4 revenue, you get roughly $63 million a year. That's fine, but it doesn't justify a $2 billion market cap.
That is completely the wrong math. That assumes a flat line. You don't annualize the first quarter of a launch, you compound it. If you apply the compound monthly growth rate consistent with this 6x signal, 2026 revenues are not going to be $60 million. They could approach $163 million. The market is pricing the flat line, the bolus is over theory, but the data suggests an exponential curve because the stickiness of the drug is high. Once a doctor switches, they don't switch back.
$163 million is a very aggressive target. If they miss that, even by a fraction, this stock goes to $3. But let's pivot to the catalyst that sparked this latest sell-off, the Eisai partnership. To me, this was the moment the thesis broke for the arbitrage guys.
I completely disagree. It was a masterstroke of capital allocation.
A masterstroke? Come on, they got 50 million euros up front. That's roughly 60 million US dollars. For a global asset, that seems incredibly low. The market looked at that headline number and said, is that it? It suggests that Dr. Hung, the CEO, couldn't find a buyer for the whole company, so he's parting it out for scraps. It kills the immediate buyout fantasy. Investors were holding this as a lottery ticket. Now they're holding a commercial execution story with a partner in Europe. That is a very different risk profile.
You're looking at the upfront cash and missing the economics. This is the classic profit versus revenue debate. Yes, the upfront was $60 million, which is fine. It keeps the lights on. But look at the royalties. We're talking high teens royalties on net sales. And here's the kicker. Nuvation pays zero commercial expense in those territories.
So ICEI foots the bill for everything?
Exactly. ICEI pays the sales reps, the marketing, the distribution, the regulatory filing fees. That royalty stream is 100% pure profit margin. It flows directly to the bottom line.
If ICEI sells any.
ICEI is an oncology heavyweight. This isn't some small regional player. They have Lenvima. They have Halaven. They have deep relationships with European oncologists. If they generate $200 million in sales in the EU and other territories, Nuvation gets a check for roughly $35 million. That $35 million is equivalent to the net income of a standard biotech generating hundreds of millions in top-line revenue because Nuvation has no cost of goods sold on it. This deal allows Nuvation to focus 100% of their burn on the US market while collecting high-margin checks from the rest of the world. It extends the cash runway to 5+ years. The market selling off on this is a fundamental misunderstanding of net present value.
It might be a misunderstanding of value, or it might be a realization of timeline. Those royalties don't hit the bank account tomorrow. The stock is trading today. And when we talk about valuation, we have to look at the benchmarks. You call this a great divergence, but is Nuvation actually cheap? Let's compare it to Syndax Pharmaceuticals. Syndax has double the revenue, roughly $32 million in their recent quarter, yet their market cap is around $1.4 billion. Nuvation has half the revenue and a market cap of $2 billion. That is a massive premium. To me, that suggests the stock still has room to compress. Why should Nuvation trade at such a rich multiple compared to a peer executing just as well?
Because not all revenue is created equal. That is a lazy comparison. You cannot compare the ROS1 non-small cell lung cancer market to the acute leukemia market Syndax is in.
Why not? A dollar is a dollar.
Not in biotech. It's about the lifetime value of the patient. The ROS1 market is significantly larger, but critically, it has a much longer duration of therapy. Remember that 50-month stat? Patients stay on ibitrazine for years. In acute leukemia, the duration is unfortunately much shorter due to the aggressive nature of the disease. One ibitrazine patient is worth 3 or 4 Syndax patients in terms of total revenue over time.
So you're paying for potential again. You're paying for years 3 and 4 today.
I'm paying for the asset quality. If you want a better comparison, look at Kura Oncology. Kura is trading at roughly 1.4 times their cash. Nuvation is trading at about 3.3 times cash. Yes, there's a premium, but that is the commercial premium. Nuvation is approved. They are selling drugs. Kura is still purely clinical. The market is right to award a premium to Nuvation, but my argument is that the premium should be higher given the de-risked nature of the asset.
De-risked is a dangerous word, which brings us to the pipeline. Right now, the stock is behaving like a one-trick pony. If the ROS1 launch falters, the valuation collapses because the market is assigning very little value to the pipeline. Safusidenib is the next asset up, but look at the landscape. Vorasidenib has already set the standard in IDH mutant gliomas. Why do we need another IDH inhibitor? It feels like they're late to the party.
They aren't late. They are entering a different room. You're confusing the indications. Vorasidenib targets low-grade gliomas. The Indigo trial was a success, absolutely. But safusidenib is targeting high-grade gliomas in the Phase 3 G203 trial. This is a completely different patient population with a much higher unmet need.
It's a harder population to treat. High-grade gliomas are aggressive.
It is harder. But safusidenib is a differentiated molecule. It has shown preliminary data suggesting it retains efficacy in contrast-enhancing tumors, which is where other IDH inhibitors have failed. If G203 succeeds, this isn't a Me Too drug. It's a second blockbuster franchise. The market is currently pricing safusidenib at 0. It's a free option at these levels.
Or the market is pricing it at 0 because high-grade gliomas are a graveyard for drug development. But let's step away from the biology and look at the plumbing, because this is where I get really nervous. We need to talk about the market microstructure. Short interest is sitting at 18.02%. That is over 41 million shares sold short.
I see that as fuel.
It's not just fuel, it's a signal. Smart money, institutional money, is betting heavily against this stock. And it's not just the visible shorts. Look at the dark pool volume. It's hovering around 40%.
Can we just clarify that? Dark pools sounds nefarious, but it's just private exchanges for large blocks.
Right, it's off-exchange trading. When you see a stock trending down from 9 to 6 with 40% dark pool participation, that is usually institutional distribution. That is whales exiting quietly so they don't crash the price even faster. It suggests the smart money wants out.
Or it's the exact opposite. I interpret that dark pool volume as accumulation. We are sitting at a key support level around 585. If you are a fund like Baker Pros, who we know is a major holder, and you want to increase your position without tipping off the market and driving the price up, you use dark pools. You buy in the shadows. And regarding the short interest, look at the days to cover ratio. It's between 5.4 and 7.5 days, depending on which average daily volume you use.
It means if they get squeezed, it hurts.
It means if there is any positive catalyst, a good earnings print, a clinical update, it would take over a week of buying every single available share for the shorts to cover their positions. That is a coiled spring. You mentioned smart money betting against it, but I would argue the short interest is crowded. It's a consensus trade that has become too heavy on one side of the boat.
There's another signal we should look at if we want to talk about crowd wisdom. Have you looked at the correlation with Polymarket?
I have. It's fascinating.
It's the theoretical arbitrage. Right now, the equity market is pricing Nuvation as if the pipeline is dead and the launch is mediocre. But if you look at prediction markets, specifically around FDA approvals and oncology trends, the wisdom of the crowd often diverges from the equity pricing.
Exactly. If you check the implied probabilities on prediction platforms for IDH inhibitor approvals or general FDA leniency in oncology for 2026, the sentiment is much more bullish than the Nuvation stock price implies. There is a signal divergence. The equity market is pricing in failure, while the broader prediction data suggests the favorable regulatory environment. If I can buy the stock at a price that assumes failure, while the prediction market suggests success, well, that is an arbitrage opportunity.
That assumes the prediction markets are liquid enough to be efficient, which is a big if. But let's look at the immediate technicals. The RSI is 27. We are oversold. Does that mean we bounce? Maybe. But catching a falling knife usually results in losing fingers. Until I see the stock reclaim the 50-day moving average at 695, this is a show-me story. The trend is down, the volume is red, and the shorts are in control.
But that is exactly when you want to buy when the capitulation has happened. The RSI being under 30 for a company with $615 million in cash and a drug growing at 6x the benchmark is irrational. This is the definition of value investing. You buy the dislocation.
Or you buy the value trap. The risk here is that the 6x launch data plateaus in Q1. If they report earnings and that growth curve flattens, the valuation multiple compresses further. And with 18% short interest, if they miss the next earnings call, this stock doesn't stop at 5. It goes to cash value, which might be $3 or $4 by then.
I just don't see the plateau coming. The feedback from the field, that cleaner CNS profile, is sticky. Once a doctor switches a patient to ivermectin and sees they aren't getting dizzy, they are not going back to repotrectinib. The stickiness of the revenues being completely underestimated.
We will see. The market is clearly worried about the competitive response from Pfizer and Roche. They have deep pockets, and they can bundle.
Bundling doesn't cure brain mats. Clinical efficacy eventually wins.
Time to wrap this up. For me, despite the cash, the trend is broken. The sell the news psychology is dominant. The market wanted an exit, didn't get it, and is now punishing the stock. That 18% short interest is not there by accident. It suggests the pain isn't over. I think caution is the only prudent move. I'd wait for the technicals to repair themselves before trying to be a hero.
And I see this as a rare asymmetry. The market is wrong about the launch trajectory. 6x is the only number that matters. The market is wrong about the ESI deal. It's pure profit, not a consolation prize. And the squeeze potential is massive given the days to cover. This is a buy on the great divergence.
We can agree on one thing. The upcoming Q1 earnings are going to be the definitive test. If that launch curve holds, the shorts are in trouble. If it flattens, the bulls are trapped.
It will be the moment of truth. Until then, keep your eye on the volume.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.